We'll we'll just get going here. Hopefully everybody can hear. I think the people online can probably hear better than the people in person, unfortunately. So, anyways, real estate professionals from cash waster to cash savers. So I'm a former IRS auditor, ex-IRS auditor. I consider myself to be an expert when it comes to auditing at the IRS because that's what I did for a long time. And again, those five most expensive words, this could have been avoided. And so my mission, my desire is to help people to avoid mistakes, pitfalls, things that happen that shouldn't happen at all. So this is where this presentation came in. I wrote it a couple weeks ago. The IRS Dirty Dozen. Who's heard of the IRS Dirty Dozen? Is anybody? Now I don't have microphone access I can't hear people speaking. So I'm just gonna think that people are like, yes, yes, I've heard of
No,
that.
we haven't heard it. Everybody's shaking their heads.
Nobody's heard it. Okay. So we'll talk about the IRS Dirty Dozen. We'll talk about overpaying, stopping overpaying taxes with smart strategies. We're going to talk about AI because AI is in the buzz, right? People are talking about AI. So let's use AI effectively. Let's think about how the IRS is going to be using, and they already are using AI, and avoid IRS red flags and audits. So my next slide, as I move it through, maybe. Come on. There it is. Great. Did you know that taxes drain bank accounts faster than any other expense? Because that's the largest expense that we have over our lifetime. And it's just crazy because when I audited at the IRS, so many people, I felt like they were third graders out playing t-ball, and they're like staring at the sky, looking at the airplanes or looking at the dandelions, and they weren't in the game. They were not in their own game. And I was auditing, and I felt like I understood their bank accounts, their finances. I was more interested in their money as an IRS auditor, tracking where things were going, if things were written off correctly, than they were. Because a lot of times they just don't know. People don't know. They haven't been taught. And it just frustrated me. And I talked about the five most expensive words, but I think the six most expensive words are my accountant takes care of it, right? My accountant takes care of it is the six most expensive words. That is so true. I've seen that so many times. A lot of times people will think, oh, my accountant has it. They don't. Accountants steal more wealth than any other profession in the world. Then I talk to attorneys and they say, well, no, I think attorneys steal more wealth than any other profession. And I'm like, I'm not here to argue. I'm just here to say, listen, we can't rely upon our accountant to take care of us. I'm an accountant, right? And I can't follow my clients around to say, are you deducting that? Is this in the right spot? Are you organizing your expenses and records to bulletproof yourself against a due diligence claims? So think about due diligence. It could be an IRS audit, it could be a lawsuit, it could be a death, disability, divorce, disagreement between partners, whatever. Any type of bank loans, any type of due diligence that's going to come about, we need to be prepared. And so, how do we be prepared? Yes, taxes are our biggest expenses that we have and we want to safeguard, but there's also a lot of other threats. And we'll talk about the Dirty Dozen, we'll talk about AI, talk about these things. Those are important. And so my job is to put cash back in people's pockets. I'm interested in building cash. Cash is king, right? It's like flying in an airplane, right? A pilot will never take off without doing a physical check. They're not going to rely upon their gauge in the dashboard. They're going to go out there and get on the wing, if it's a small plane, and get an instrument and actually check the fuel. And that's cash. Or a big plane, they'll do checks. They'll go around, and you want those safety checks. Or if you go into surgery, they'll go in and they'll do safety checks. And I went into surgery, I had a little thing removed out of my wrist about a month ago, and they did so many checks and balances, right? I remember right before I got conked out, there was like five people in the room, and there's like anesthesiologists, the surgeon, and other people. And about the third person, I was out, but they said their name, what they were there for, who the patient was, the outcome that they were going to get, And the results, right? They named it and they claimed it. And that's in the medical profession. If we brought that due diligence to our own finances, to our own records, how much further ahead would we be? Not to use books and records for historical record keeping, like driving in the rearview mirror, because that's how most accountants think about it. Oh, what happened last year? Tell me about last year. And maybe they'll do some projections and maybe they'll look at some numbers and say, well, if you bought this or that, that's not planning, that's just projections. That's just taking, hey, these kind of what ifs. But I'm talking about planning to actually save money, to put money back in your pocket and to protect. And not everything is taxes paid to the government. My definition of a tax is anything that you pay that you shouldn't have to pay. For instance, like PMI, purchase money or private money insurance, right? So a lot of times if people don't have 20%, they will have to pay an extra fee or a state tax. Probate. Probate's not a tax, but it's still something that has to be paid. So let's think about all the stuff that we're paying that we don't have to pay. I consider that to be a tax. We're putting money back in people's pockets. I'm looking at people's finances and say, well, why are you paying that? Let's lower your risk, lower your expense, have a budget, and think smart about where you're spending money and being planning and being prepared and taking these financials and not just using historical record keeping, but budgeting and forecasting and looking at that gas in the gas tank to help us to get to our destination. Like if a pilot was flying an airplane and they're going to go into a headwind, they're going to want to make sure that they have enough gas, right? I mean, so many planes crash because they run out of gas. And so many businesses, the reason they file bankruptcy is because they ran out of cash. And the number one fear of retirees and business owners are running out of cash. Nobody wants to outlive their money.
Right, guys.
Nobody does. So, are we good?
Yeah, sorry about that. I was just seeing if I can get to the chats. Okay.
Should I continue?
Yes, sir.
Okay. So, unique challenges for real estate professionals, right? We have fluctuating income, irregular income sometimes, and it makes things complicated for tax planning. Sometimes we might have self-employment income. Sometimes we might have passive income. Sometimes we're trying to make income that's passive active or active passive, and it's kind of playing a game of when do we want things. So there's this battle between self-employment, multiple streams of income. There's complexities in reporting various sources of income. There's this saying that you have multiple streams of income, but multiple streams of deductions, right? Rich dad, poor dad stuff is all about multiple streams in case one stream income dries up. But again, on the other side of the coin, we want to reduce red flags, IRS audit issues. We want to protect and preserve as much as we can. And that's where we might have multiple businesses. We want to have contracts paying one business or another. And then we want to have extensive record keeping. We need meticulous tracking of expenses, income. And for most real estate professionals, for most people, bookkeeping is not a high priority. It's not a favorite activity for most people. And I get it. It's tough, it's challenging, but hopefully this course and this class will help to see why we need to focus upon bookkeeping, not just for historical record keeping, but for future planning, for budgeting, for forecasting, for protecting our assets. And so the next thing, I like to ask people before we get too far into this, are you happy? Are you happy with the amount of taxes that you paid last year? And most people are like, no. And I say, are you sure that you're paying the lowest amount of tax possible, legally, ethically, and morally, right? I want to do things above board. I don't want to do things that's shady, but there's no black and white when it comes to the tax code. And since taxes are our biggest expense that we have over our lifetime, let's legally, ethically, and morally reduce those and prepare for the worst, right? We expect the best, but prepare for the worst.
Right.
So now we transition to the IRS. We transition to AI. AI is in the media, it's everywhere. So how is the IRS transitioning and using technology, because their technology is so outdated? And I feel and I see it a lot. I was on the IRS this morning for 3 hours, talked about 4 different people, and I got the answer I wanted, but it took a long, long time. And I asked them, hey, since, has things been a little glitchy lately? Because, things have been kind of poking around in the treasury. And they're like, yeah, it's been a little glitchy this year. Well, I think there's a lot of changes coming within the IRS, especially with AI being injected. So we're going to see a lot more things, a lot more red flags, a lot more issues that we didn't see before. And they're going to be picking up little nuances. And that's why we need to be prepared. That's why we need to be taking due diligence and record keeping a lot more seriously, because AI is going to start tracking, and I start put behavior tracking the last point. And that is so important because AI is going to start looking at, hey, you did this last year and this year, and then, hey, you refinance. And I see this, and what's going on? One example that I use, and it just drives me absolutely crazy. Somebody takes and they refinance their house. They get a HELOC or they refinance and they go buy a rental property or investment or a flip or something. But there's a disclosure that needs to be put on your tax return when you use that HELOC for something else or refinance. You can't take that interest in that you paid on that HELOC when you use it for other than buy, improve, or build your primary residence. You can take that money and use it for other things. You just can't deduct it. But people want to deduct it, right? Because it's going to be sometimes less, or they leverage that HELOC that they have or that equity that they have in their house. So it's called a 10T disclosure. And I talk to so many accountants out there, people that have been in business for decades, 30 years. And I ask them, hey, how often are you disclosing to your clients and you're actually putting this 10T disclosure on the tax? No. What are you talking about? Right? I'm educating people that have been in business for 30 some years, or people brand new, they don't know it. And it just drives me crazy because this 10T disclosure is really, really important. It's not a form. It's a disclosure. It's a written disclosure saying what I'm going to do with this money and why I'm going to put it over here and deduct it as a rental expense or investment in a property or piece of equipment. You have to put that with the tax return in order to have that deduction. And that's where this behavioral tracking is going to come in. And I'm seeing that where the IRS is going to be like, well, you refinance, but I didn't see this 10T because it's going to be faster and faster. And if we don't know about it, we're going to get hit with a notice that says, prove that you filed this 10T disclosure. And the accountant's going to be like, what are you talking about? Or
Hey,
do it yourself software.
Daveed, ask everybody.
Mute your phone.
I have it muted. Um, ask everybody if, or who all knows what that is, and if they have a HELOC they're investing in.
Yeah, so the Grace asked if people know what the 10T disclosure is, and I don't think most people are going to know because most accountants don't know. And what a HELOC, and so taking the home equity line of credit, the HELOC, or refinancing the house to buy. And so Grace was asking if people are doing that. And what it is a disclosure, and there's no form. You just have to put with the tax return when you file the original, when you take that home equity and you use it for something other than buy, build, or improve your house, you have to put that with the original tax return. And if you haven't done it, then you go back and amend that return. Or if the statute of limitations told, then I would just disclose it right away, what you've done. And it's just a disclosure, and it says what you're doing with the money, and there's a code section. And I've made a video, it's on YouTube, and I can send that to the group. This 10C election disclosure. I call it an election, but it's a disclosure. People like get a little confused when I say elections because it's a disclaimer that you put on the tax return. So is an election, disclaimer, disclosure, those are synonyms in my mind, it means the same thing. So Grace, are we cool? Can I move on?
Yeah.
Okay, excellent. So IRS red flags, LUQs, large, unusual, and questionable, LUQs. This is what most audit flags, audit happens. Like there's several different types of audits, right? Sometimes there's this CP 2000 notice, which means that you get a mismatch of like, hey, there's a 1099 that should have been reported and it wasn't, or it was wrong, and you get a W-2 and you forgot or whatever, interest or K1, whatever, right? So the computer just goes automatically and sends you a notice, right? No human interaction whatsoever because it's a matching. But then there's a real audit, and there's three types of audits. There's the audit that is just sent out through a correspondence, like that CP 2000 notice. That's kind of an audit, but it's kind of a double check. But there's another up from that, which is a human will actually take a look at it. So you file your tax return, it goes to the computer in the sky. Computer in the sky will look at it based upon these statistical algorithms, and it's called a UI-diff score. And so what does the UI-diff score mean? I don't remember. It's uniform differential whatever. So it's some number that they have, and they are constantly doing research projects. And I was on lots of different research projects where they're refining their statistics, trying to get the most dollars for the hour because it's expensive to audit, right? With humans and stuff, with AI, it's going to be a lot less expensive. So they'll just be sending out tons of notices. But when I was auditing, it's more human based. So your tax return gets filed, computer in sky, it's electronic, and then they print it off, right? And there's these like 10 or 15-story buildings in various places in the United States. Like the closest one is Ogden, Utah. So we'd fly over to Ogden and fly into Salt Lake, go to Ogden, and there's this 10-story building or a 15-story, and it had its own zip code, right? The IRS campuses and where you send IRS like checks and stuff and tax returns if you paper file, they have their own zip code. So it doesn't get mixed up with another address or whatever. So that building, and so there's what, 15 or so these big service centers in the United States, and like Memphis and Connecticut and whatever, like different places. Anyway, so they print off the tax returns, and it's just like this huge library. It's just like dusty and it stinks. It's kind of moldy and stuff. It's not the best place. I have to wear like a mask and stuff because it's like a COVID mask, but that was before COVID. Anyways, just because of all the dust, but and we look at and say, hey, this is why I think this tax return should get audited because we're looking for large, unusual, questionable, the bloops, right? So if we saw like a big red dot, I'm going to explain what a large, unusual, questionable is. So my definition would be like the example of a big red dot on the wall. And it's like, what is that? That's kind of weird. But if it had a sentence to it and it was just a period, it's like a motivational quote. Well, it won't be that weird because there's context to it. But if that dot was by itself, and that's what a large, unusual, questionable is to me. Also think about another example is that similar to buying a piece of property, the IRS will basically audit on the street. So for instance, somebody most likely will do the RMLS research. They'll see the property before they go in to inspect it. They've done the research about the schools and the markets, shopping centers, and they've done the evaluations, and they know as much as they can before they go to look at the property. And then they go into the property to inspect it. Sometimes people just buy the property without inspecting it, and it's contingent or whatever. But a lot of times people go into the property to inspect it to see if, there's things you can change the carpets and the wall colors, and it just depends. But if the foundation and the roof and there's like squirrels living in the roof, I don't know. Same thing with IRS audit. They audit on the street and they go into inspect. They're looking for usually the 3 to 5 largest expense items, and they'll either expand or contract the scope of the audit. So how do we reduce our audit chances, our risk of being audited? It's reducing our large, unusual, and questionable items. So in real estate professionals, the passive activity loss limitations, the PALs, is very complicated in the 469 rules in Internal Revenue Code 469. Our life is driven from Internal Revenue Code, right? We talk about 401ks, right? We talk about there's so much of the IRS code that drives day-to-day living. And we don't even think about it, but we live with it. And so, especially with real estate professionals, understanding 469 is going to be very, very important. The whole code's like that 400 section is important. Not that you have to be a tax professional, but again, if we understand and we have the premise that my accountant rips me off, right? And I'm an accountant and I'm here to try to help people because I don't want my clients to say, my accountant cost me money and I'm their accountant. And that's why I have a course and that's why I'm doing this education because I believe in education and I can't follow people around. And it's not always what I know, right? And so my wife is like, well, I thought the most expensive words was, I should have told my accountant. I'm like, yeah, I get it, right? So I should have told my accountant or my accountant takes care of it, whatever. And so educating yourself. And as an accountant, I'm the guide, but you're the hero. I'm here to equip you. I'm here to help you to win the day. And so passive activity loss limitations is so important. The next bullet point to the right is active versus passive income, avoiding self-employment tax. We want to avoid self-employment tax. Why? I don't really want to pay into the system that I'm probably not going to get a whole lot out of. And so really setting a reasonable compensation, especially if you have an S corporation, you want to bring that reasonable compensation down legally, ethically, morally to the bare minimum and audit proof it. I use a program called RC Reports, and it uses Bureau of Labor Statistics. It uses time and motion studies, what you do and how long you do it and how well you do it based upon zip code. So you plug that in and we run analysis to figure out how much you should be paying yourself instead of just throwing spaghetti noodles against the wall and hoping it'll stick. Because so many times when I was an IRS auditor, I would challenge people and say, that's not reasonable. And somebody might be saying they're paying themselves 40,000. I'm like, well, I think you should be paying yourself 180,000. Like, based upon what? Like, based upon these statistics, based upon what you've told me. And they're like, well, you're wrong. I think you're wrong, right? There are so many times that I would do prepare penalties against people who didn't do their due diligence and gave them a $5,000 prepare penalty because they didn't do the check boxes. They didn't ask the right questions. Oh, sure, that seems reasonable. Based upon what? Reasonable, I think, is the most expensive word in the dictionary. Reasonable. What is reasonable to me is not reasonable to somebody else. We look at divorce courts is littered full of reasonableness. What's reasonable to one person is not reasonable. And divorce, when it comes to domestic or business, I mean, there's so many lawsuits with partners in disagreements. So reasonableness is so expensive. The next thing is real estate professional, the rep status. When are you a real estate professional? When do you want to be a real estate professional? When don't you want to be? A lot of people are like, I want to be a real estate professional. Really? Why? Right? I'm trying to talk people out of being a real estate professional because there's a lot of benefits of not being it. And there's other loopholes and other things to take into consideration that might offset. We got to think about what might be accurate is maybe not relevant. And understanding the difference between accurate versus relevant. Because the advice that, or I'm not giving advice, we're just having a conversation, right? So this information that you're getting here might be accurate to you, but is it relevant? No, it's not. Why? Because everybody's situation is different. Because you might have kids, you might have in-laws, you might have businesses, you might have this, you might have that. You have to really take this knowledge and apply it and make sure that it's going to be both accurate and relevant to you. You know, it's kind of like taking a drug. Go to the doctor, this drug might interact with this drug, and they conflict. And we don't want to have that. And that's the difference between accurate and relevant. So we want to use some knowledge, some real intelligence, not just artificial intelligence, because I don't know if you've noticed this, but ChatGPT is wrong a lot, right? I was just querying ChatGPT. I was asking a question. I'm like, give me all the states that have the letter M in it. And it gave like 20 some. And I'm like, you're wrong. And it's like, oh, sorry. And it came back with like 14 or something. And I tell ChatGPT it's wrong. It's wrong a lot. It makes things up. It hallucinates. That's what it does. It hallucinates. And it wants to make you happy. But it's wrong. And so that's the last point. Relying upon my AI is not a penalty excuse. So people file their tax returns, and I see these commercials from big box do-it-yourself software. Oh, it's answering all these questions. Well, my software told me. IRS is like, sorry, that's not an excuse for penalty. What are we going to do? Move on to the next slide. That's what we're going to do. Take a drink of water. Okay, as I mentioned, no excuse for penalty relief for relying upon AI advice. Why? AI doesn't qualify reasonable cause. Right? IRS doesn't consider penalty abatement if you rely upon advice that's not from a qualified tax professional. AI is a tool, it doesn't meet the standards and aren't recognized as a valid source for advice. Misunderstanding the tax laws isn't forgiven, right? So the IRS expects you to show good faith and due diligence. Misinterpretation of the tax law to AI advice doesn't protect you from penalties. I'm kind of beating this one up, but AI misses nuances in your tax situation. Generating AI response can't handle the complexity. It might in the future. Case specific, and that's where the accurate versus relevant comes in. It might be accurate, but is it relevant to your situation? And then AI lacks accountability. There's no documentation, no professional accountable standards, no defense for errors. Unlike tax professionals, AI won't back you up in an audit. All right, next slide. Common audit triggers, real estate professionals, unreporting income, Form 1099 mismatch, IRS, so it might send out CP 2000 notice. I put home office deduction, excessive or improper calculation for depreciation. For instance, if somebody takes a home office, we cannot depreciate the land. We cannot depreciate land. It's only the improvements upon the land that we can depreciate. And so often I see people, they'll just take for home office, for instance, they'll take the full house without the land, or they won't take depreciation at all. It's kind of all or nothing. I'm like, where's the home office deduction? None. Or if they do, there's no depreciation because it's complicated. They don't know how to maneuver through that. So home office could be too much or not enough. And the problem about home office, and it's considered, when you take home office and depreciation, it's considered allowed or allowable, which means if you take a home office and it's other than the safe harbor, it's a regular home office where you're taking square footage and all that stuff, and you don't put in the depreciation, technically, you're supposed to depreciate that. You're supposed to recapture that when you sell the property. A lot of times people miss that. The IRS systems aren't that sophisticated yet, but I feel like they will be soon because of AI. They'll see that. They'll look at that. They'll ask you a question. Hey, it doesn't look like you recapture depreciation. You've had a home office. We think that you should. Here's a assumptive tax bill. You owe 15 grand or whatever, right? Based upon some calculation that they came up with. Assumptive tax is something that the government loves to send out, right? And so many people I'd rather pay it than deal with it. I see that all the time. Oh, here's a $2,500 or $1,600. They just rather pay it. They don't have the time. Okay. Bummer. Vehicle expense. Disapportionment miles. Also, like, people will take standard deduction or actual or both, right? So you only can take standard mileage rate or actual expense. You can't take both. And it gets kind of complicated. There's a lot of nuances in that. Large charitable donations. A lot of people who are in real estate professionals, very charitable, very giving, very kind. But if it's not to a qualified charitable organization, there's a lot of fraud when it comes to charitable donations. And you also have to get a letter from that charitable. It has to be 503c or whatever registered. And it's got to say that no goods and services were given in exchange for that donation. So it could be in kind, it could be a like kind, it could be real property, it could be stocks, it could be let's see, required minimum distributions, RMDs, right? People donate that. So if there's anything over $5,000, so this is like number two. Point number two. Point number one is if you got to have that little statement that says no goods and services. Number two, if it's over $5,000, you've got to, for everything, for the charitable, you have to get an appraisal done. So somebody might, like, for instance, donate a car for $4,000, and then they move or something. They move, donate the car. They have a whole bunch of stuff that they get rid of, and they say it's $5,500. Well, they have to get a valuation on everything, and I've seen so many people lose when they didn't know that rule, and it's sad because very charitable. They gave it to a good cause, and it just was disallowed, and they had to pay that back. Sad. I don't want that to happen to you. All right. So steps to stay compliant, avoid penalties, maintain accurate records, keep detailed records of all income and expenses, file on time. File on time. Number two, a lot of times people are like, I can't pay my taxes. Well, file. Make payments later, but there's failure to file and failure to pay. Let's deal with the failure to pay penalties. We can get set up on an installment agreement. We can do other things. But what happens if we don't file, and there might be information reporting that there's no tax due, for instance, a K-1 from a partnership or an S-corp or maybe a 1099, right? Those are no tax due on those things, but there's a filing requirement. And with K-1s, it's $197 per K-1 per month. It can add up. It gets expensive. So file on time with extensions. Report all income. I recommend pulling IRS transcripts. We'll talk about that a little bit later. How to do that, when, where, all that stuff. Double check deductions. Verify all claimed expenses that are legitimate and document. What I mean by that, in order to claim a deduction, it's got to be ordinary and necessary for production, collection, and preservation of income. I'm going to say that again. Ordinary, necessary, production, collection, and preservation of income. What? Who wrote this stuff? Well, a bunch of attorneys wrote this. And if there's anybody that's an attorney, I don't mean to offend you. I don't mean to step on your toes. But to be honest, you don't really speak human. So attorneys, it's can be, especially code, right? Tax code or whatever. It can be tough to understand and interpret. And what they teach attorneys typically in introduction to law school is the law is the law when the judge says it's the law. Right? And so sometimes people poke the beehive and push the buttons. This depends upon your aggressiveness and how aggressive you want to be. So anyways, so double check, make sure it's legitimate. It's ordinary, necessary for production, collection, and preservation of income. Ordinary, necessary for your business, right? Each business is different. And then stay current, right? Try to educate yourself as much as you can. That's why, Grace, you're doing such a great job with RIA and trying to educate people, bringing people, speakers like me to help to avoid those 5 mistakes, avoid the 6 mistakes, right? All these things. Put money back in your pocket so you can do the things that you want to do instead of just overpaying to Uncle Sam, which I know everybody loves to do, but in reality, we don't. All right, next thing. So some solutions, some AI tools, everything I think is in our pocket, right? It's on our phones. So let's just use our phones to help us to navigate. And so here's some ideas. So for instance, I like using Zoho. So Zoho is great for expense tracking, has AI tools. There's MileIQ, there's Divvy, Expensify. There's a whole bunch of other ones. These are just some examples. So mileage tracking is really good, built-in GPS, third-party apps, etc. Expense tracking, AI-based. OCR means optical character recognition, OCR, so it reads it, right? Pulls it in, it helps you to classify things. So that also virtual cards are really important. So virtual cards are great. I love virtual cards. Spinning up a new card, spinning up a budget. I use Divvy a lot for that. Because what happens is maybe we want to have a subscription to something, right? We find this Black Friday sale or Cyber Monday or something. It's a great deal. And hey, I put my credit card. Maybe you thought it was a one-time deal, and then it turns out to be monthly or quarterly or yearly. And now you can't get off that payment. Or maybe you forget about it. It's only 20 bucks or whatever. But it's like the next month, 20 bucks, the next month. And you like look back like, oh gosh, 9 months later, still billing me. Ouch. So these virtual cards allow you to create a budget, to put a card, a physical card number in, and then be able to monitor and turn it off. If you're like, I want to stop my subscription, but they keep on billing, it's like, I just turn that baby off. I freeze it. And it prevents this ongoing getting charged month and month and month and month. And that just, it's another waste of money, right? It's another drain of tax or of cash, excuse me. So we're overpaying something that we didn't want to. That to me is a tax. Let's stop that. So using technology like Divvy or other virtual cards to help you like with these little subscriptions. I had a client and we're doing her bookkeeping. She's getting caught up in January or February, and she sees this $3,700 expense charge, and she's doesn't know what it is, does the research, and I don't have receipts for it. She calls the financial institution, the credit card, and after time, like determines that it's a total fraud charge. And she's like, okay, I'm going to report that as a fraud charge. And the financial institution says, sorry, ma'am, you had 30 days to notify us. There's nothing we could do. She lost $3,700. But then, yeah, that was a big chunk and that hurt. But what about all these little $20 here and $20 there? Those still add up. And so using a virtual system like Divvy or Expensify or whatever that has these virtual cards that you can spin up, and it just takes a couple minutes, but you can monitor. I've got dozens, probably 50 different cards that I've spun up, and I can turn things off and on. And so really using these are fairly inexpensive tools to put into your tool belt that's going to help protect you and put more money back in your pockets. Any questions so far?
You guys have questions? Have you used Divvy? You ever heard of it?
No, heard of it.
Nobody's heard of it.
Yeah, so bill.com bought Divvy not too long ago. So go to bill.com.
To bill.com?
Yeah.
Okay, thanks.
So it's a credit thing. You gotta, unfreeze your credit and run a credit and stuff, but it's you get points and all that stuff. Some people are like, I don't want to do it because I want my airline miles or whatever. Okay, well, how much money are you losing because you aren't controlling your spend? Your fuel is just evaporating, right? Your cash. So Divvy, I mean, there's a lot of other stuff out there. Expensify has a similar virtual card type stuff. So vet, like, do your due diligence. This is just one example. I use Divvy. I like Divvy, but there's other ones out there. Okay. Nice. So again, I'll give you these PowerPoint slides later. How AI simplifies tax return and planning, automate expense tracking. We kind of saw that for like staging. This was kind of meant for like a real estate agent type thing, but flag errors before they file, reduce audit risk. It can help you to look for those large, unusual, questionable. You might not think of what a large, unusual, questionable is. I'm actually kind of disappointed in the AI that I've seen so far, because some of the big tax prep software companies that I've kind of played with, they're looking, oh, you got a low audit risk. Well, I get it for like earned income tax credit, but for a large, unusual, questionable from a business audit standpoint, I'm like, this is ripe, right? If I was auditing this tax return, if it came across my desk, I'd be like, want to dig into it, and it would be juicy, man. It would be good. And the AI is like, oh yeah, it's fine. I'm like, no. All right. So I don't know if the AI is trained to have that acute awareness of what maybe an IRS auditor is looking for. I think they're looking for other algorithm statistics, not necessarily what's on a business return. Maybe for like, is more audits are done on earned income tax credit, right? On child tax credits, and more, I think, money and issues are spent on who claims this kid. I mean, when back in the 80s, when they required Social Security for kids, like half the kids went away at that year, right? So half the population kind of deceased when IRS requires Social Security numbers for dependents. They were no longer deducting their dog and cat. Anyway, so we're going to be seeing more of those types of AI type audits and stuff. But I don't think a lot of people are dealing with
Internet
EIC stuff.
fraud. Like, I don't know how many people watch the Super Bowl, but I saw these AI ads for preparing your taxes, was TurboTax, and it would show a guy talking to you, like he's gonna be your tax advisor. It's AI. So I don't know if you guys are aware of that, because I have a Tony Robbins AI. And he answers, he helps guide me and motivate me. Write scripts for me. So I realized that those were AI ads that TurboTax was putting on and stuff like that. How many of you guys have noticed that? Noticed any AI? Yeah, a few, yeah. Okay, sorry, I just wanted to mention that.
Yeah, it's scary stuff. So AI tools, effective expense tracking, daily logs, right? It's going to help us, and we're going to need it because I don't think it will be too long when the IRS says with your tax return, okay, upload all your expenses, right? And just with your tax return, just give us everything. And just keeping logs, keeping, having the phone app, like these apps with the mileage, it's kind of like swipe right or left. It's like a dating app, it's like I like or not, it's like my business miles are personal, right? Swipe right or swipe left. And so my IQ, these other apps, especially if people are driving a lot, it's going to be really important to track that stuff. Digital storage, keep things in the cloud. Man, oh man, oh man, oh man, it drives me crazy because I see and I hear people having these shoe boxes full of receipts. And I remember being an IRS auditor and people would be like, giving me the shoe box. And they're like, here you go, IRS auditor. And there'd be like, kick back and I'd open up the box and I'm like, what's this? And they're like, it's all my receipts. Go have fun with it. I'm like, where's the organization? Where's the tick, tie, and calculate? Where's all this stuff? How does it work on the return? Well, it's all in there. I know it's there. And I'd be like, I'm sorry, I'm not your bookkeeper. And I'd slide that shoebox back across the table with an audit report and say, you have 30 days. You better get this figured out. And by the way, we just opened up the other 2 years. That's on the statute of limitations. So you've got a lot of work to do. You better cancel all your meetings, better cancel your vacation, cancel that wedding, cancel all that stuff because you're not going to have any time because you're going to be working night and day and night, getting this stuff figured out. Otherwise, you're just going to have to pay. And it would ruin people's day. And it was sad. And I didn't really like that. And that's why I kind of washed out for a lot of reasons. But it's not the best place to make friends and influence people. It wasn't the best place to get a date when I was dating. Well, what do you do? I'm an Irish auditor. See ya. People didn't want to hang out with you. But those 5 words, this could have been avoided. And that's what I'm trying to help people to do. So keeping good records, AI is changing the game. Scanning, organizing, keeping things digital, electronic. Go to the store, coffee or whatever, get those receipts electronically. And it gets texted to you or emailed, then you send them off to your accounting system. And that one slide with all those different types of AI or QuickBooks or Wave or Zero or whatever, just upload those receipts for the business. Keep all receipts. And people say, well, I don't have to keep receipts. My accountant says I don't have to keep receipts. Bank statements and credit card statements are good enough. I'm like, oh, really? Is that what the tax law says? Is that what the Internal Revenue Code says? Well, I don't know. Well, there's a $75 rule. Under 75 bucks, I don't have to keep a receipt. Yep, you're right. But you still have to keep a log. Still have to have the date, the location, the amount, the purpose, basically everything that's on the receipt. Get in the habit of keeping receipts. If you can't prove it, you lose it. If you can't prove it, you lose it. A lot of times, oh, I got this receipts. It's in a shoebox. It's in the basement. Oh, I had a flood. Oh, there's mold. Sorry, bank statements and credit card statements are not enough. So the question comes up, how long do I keep receipts for? And it really depends. So if I buy a commercial property or do stuff to my house that's considered commercial, it's 39 years for depreciation. So 27 and a half years for residential, 39 years for depreciation for commercial, non-residential. They don't have industrial. It's just 27 and a half years is 39. So if I put solar panels on my roof for my house, and I'm taking that as part of my home office, then I've got to keep records 6 to 7 years after I dispose of that asset. So it could be a long time, right? Sometimes people have, I buy in property and I'm going to hold it and I'll do a 1031 or I'll do a 453 DST or something. Just like I'm going to do an installment sale. You got to keep records for a long time, good records. Because in an audit, they're going to be thorough, very thorough. They're looking for everything. Their job is there to get money. Anyway, so keep good records with technology, with AI, with scanning stuff. It's a lot easier nowadays. Dave, it seems like a repeat of the same slide. Well, I don't know what happened. Okay, keep going. Okay, so practical strategies, implementing digital tracking. It's a habit, it's a whole atomic habit, James Clear thing. Just get in the habit, just one thing each day. This next thing, just continue to build that good habit. All right, set up dedicated business accounts. Do not commingle. Please, 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 please. Do not commingle. Keep business and personal separate. Oh, I made a mistake. Well, we have an accountable plan. Let's reimburse. You have 30 days to reimburse. Oh, I don't have an accountable plan. What's the accountable plan? Well, I'll talk about that a little bit later, but there's all these rules and regulations that we got to set up for ourselves. Schedule regular tax planning sessions because tax laws change. Consult with a real estate tax specialist. Get expert advice on strategies. This is kind of like what we're doing here a little bit. Real estate tax planning tips. Keep detailed knowledge. This is kind of a repeat, but invest in AI. Use AI. Stay on top of it, right? Use depreciation, offset rental property income. And again, it's a debate, right? We're the real estate industry. We're here to make money with real estate. That's our business. A lot of times people are like, well, listen, hey, I can do some tax planning and I can offset and I can save $6,000 or $10,000 on some tax planning, but then your income's real low, right? Did cost segregation, you don't pay anything in tax. People are like, zero tax. Well, you need the bank, right? It's not about the $6,000 that you're going to save on taxes I'm concerned about. It's the $20,000 that we're going to spend on hard money because we didn't go through a bank, right? Because our lender, our bank, is our best friend. And we want to look good to the bank. We don't want to have to go to hard money. And if there's any hard money people in the room, I'm sorry, I don't want to mean to offend you, but that is, I think, a cost that could be avoided. And there's a lot of money to be made if you're hard money, but you can save a lot of money. So I'm looking at the delta between the 20,000 that you spent and the 6,000 that you saved, that 14,000. That 14,000 is really what I'm concerned about, especially for real estate professionals. And often we want to be paying a lot more in tax. Why? Because we want to look good to the bank. It's a teeter-totter, right? I want to be loan worthy. I've got to have a high enough taxable income. I'm going to have to pay tax because I'm going to be saving that delta, like I talked about, of that, say, 14 grand in this simple example. I know it's not that easy, but I think you get the understanding of, gosh, let's set up your taxes and accounting systems so it's easy so that we're looking good to the bank. And yeah, we're overpaying tax, but we're saving money on interest and we're flipping, man. And there's other things that we can be doing to save you tax long term. And so it's strategy and there's a technique. And I have to ask the question, what do you want to do with the money? When do you want to do with the money? And then have to look at, we want a tax plan now, retirement and upon death. What's your succession planning? What's your legacy planning? What about the icy road incident? What if you can't go to work tomorrow? Do you have the will, the trust, the state, the stuff set up? Your kids, your pets taken care of? Like we have more pets in America as homes than we do kids. 67% of Americans have a pet in their house. 20-some% have a kid, right? So taking care of the pets, so important. Anyways, so IRS Dirty Dozen, right? So this is the big thing. What is IRS Dirty Dozen, right? Totally transitioning, switching gears here. The IRS Dirty Dozen is about scams, is about avoiding the BS. Because I don't know if you've seen this, and I don't know if you get these emails and phone calls and text messages nonstop like I do. The IRS is calling and hey, I've got this deal for you, and you've gotten, you're getting audited by blah blah blah, right? All this stuff, right? During tax season, big time, big time. Don't fall for these scams. And so the IRS comes out and says, hey, listen, we got Al Capone and we'll get you too. That's their big claim to fame, right? You see a lot more ads and stuff on social media and the TV, whoever watches TV now. But anyways, you see more of this stuff. The IRS is like, beware, beware, beware. And the dirty dozen are the scams. These are the highest, the 12 biggest things that the IRS is saying, beware of, that are scams. I was on hold, like I said, for 3 hours, and I listened to it over and over and over. The IRS says, we will never call you and tell you that you owe us money. We'll always send you a letter. We'll never tell you that you have to pay with a credit card right now, or we're going to repossess your whatever, right? They don't do that. But fraud, scams do. Be aware. Protect yourself. And please protect the elderly. Man, there's so much elderly scam stuff. And so our grandparents and our parents and stuff, we have to help protect the elderly from it's just so sad. Was there a question? Okay, continue on. So fraudulent emails, messages, be aware, like do not click on links, right? This is a zero trust type stuff, right? Do not trust email. Do not click links coming into your text messages unless you can verify it might be from a family member. They might have got hacked. So double check, man. We got to be so careful. So careful. So scams 1 through 4, data and identification theft, phishing emails, fake IRS messages to steal your data, phone scams, like I mentioned, fraudulent calls. People call you, oh, I'm from the IRS and you got to pay all this tax, or the state or whatever agency. Social media, please do not get your tax advice from social media posts. Don't click on these like zero tax, we'll solve pennies on the dollar. You don't have to pay tax ever. Like, if it's too good to be true, it's too good to be true. Right. Don't fall from that. Fake charities, see that a lot. Oh, support this poor, whatever. It's a fake charity. It's not real. You got to do due diligence on it. 5 through 8, I'm going kind of fast, but this is kind of self-explanatory and this kind of makes sense. Tax relief scams, pennies on the dollar. There's some times that makes sense, but you got to be desolate. You can't ever pay that thing back in the next 10 years. You just, the pennies on the dollars, those offer in compromises do happen, but it's usually when you're desolate. There's no collection activity possibilities. You have nothing and you owe a lot of money. And you're in a bad spot. So there's a lot of fraud. 1099 frauds, oof, 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 ouch. Right? So you might have somebody that's just a bad actor, right? Somebody that just wants to get you. And they're going to file, they might get your social security number and they just file a bunch of fake 1099s to you. That's why please do not ever give your social security number out, like especially on W-9s, right? A W-9 is an information gathering form to issue a 1099, and people just throw those around. If somebody ever asks you for a W-9 to prepare a 1099, I always get an employer identification number from the IRS. And I can show you how in a little bit here. But you don't have to have a business. You just get one. I mean, so if you have a rental or whatever, there's circumstances, right? So I would file an LLC and just get an employer identification number. Or if you just have a side business name or doing business as, still get an employer identification number for free from the IRS and not use your social. Protect yourself. Inflated refunds, preparers say, oh, I'm going to get you this dollar amount and X, Y, and Z, and they make stuff up. And it's that. Malicious scams targeting financial advice. Again, don't get financial advice from social media posts. The next is 9 through 12, financial exploitation, faking job offers, offshore scams, this stuff like this. I mean, you see this. This is pretty self-explanatory. Okay, so how to protect yourself. I'm gonna get a drink of water. So 4 things I want to talk about. IRS security pin. Some people already know this. Some people do it, and that's great. And if you have, great, help somebody who doesn't have this, make sure you get this each year. Multi-factor authentication, I'll talk about that. Credit monitoring and tax transcripts, and then educate yourself. And this is a shameless plug. So this is why I wrote my course, My Tax Secrets, at mytaxsecrets.com. It's a new course I just got out. I wrote a book about 10 years ago. I just had to get this book in a online format. And it's my first draft, and I'm doing the best I can. And Grace is like, your head's in the way. I can't move around. Well, it's like there's more down below. So I'm gonna be redoing it in the spring, but you'll have lifetime access to it. And it's good stuff. It's really powerful. So identification, how to get a security pin. So again, I'll give you these slides, but I'm going to break this down. You go to irs.gov, always type in irs.gov. Please never Google IRS because you could land on a fake site, right? You could enter in your information and give away your username and password and put in your PIN, and then you're this host, right? So please always go to irs.gov. You go there, you type in the word PIN in the search, it comes up with this. Get your ID protection PIN. You need to do this every year in January, probably around January 10th or so. They open up. Then it looks like this. It says get your PIN. Down here, I'm just going through the slides. This is what it looks like. Then you sign in through ID.me. So if you don't have an ID.me account, you need to get that. And once you do, then you sign in. And it looks like this. It'll put in your username and password. It'll text you a code, multi-factor authentication, MFA, and then you log in. And so then you have your account home and stuff, and you can get the PIN number. It's actually a little bit down below. You can apply, you can get your PIN number, but then there's going to be some other things that you want to do. So under records and status, you can get your transcripts, your IRS transcripts. So you can get those each year, see what the IRS has on file for you. Again, I'm going to give you these slides so you don't have to like take notes or whatever. So you'll get all this stuff. And then you can pull there's account transcripts for those years, wage and income transcripts. Now, like the 2024 transcripts, those won't be available until probably like May or so. It takes a while. I'm hoping the IRS with new innovations with AI, it'll be quicker, it'll be more real time, but it just takes a while for it all to compile because there's so many dang departments in there. Return transcripts and record of account. So this is good information. And again, if you already have it, great. And if you know somebody that doesn't, please help them to get their PIN number. And again, you need to get that each year. It's a silo thing for 2025. It's any tax return filed in 2025. In January 2026, same thing. You have to get a new PIN number for that year. It's like a multi-factor. So anything filed in that year, it might be amended returns or late returns or whatever. You have to have that PIN number. Otherwise, it gets rejected. And it slows down the thieves, right? So if somebody files on your behalf a fraudulent tax return without that PIN number, it hits a wall and it just bounces. But if somebody already files for you or before you do, sometimes we have to file an extension because we want to or because we have to because we're waiting on K1s or other documents or whatever. Somebody files for you and you go to file, it's just a mess. It is just an absolute headache and it's a disaster. And people will they suffer through it and they take years and years to recover from identification theft and tax theft. It's just a bad deal. And there's so much more documentation that you have to do. And just such a waste of time. It's a nightmare. I wish they would allow it for minors. They only allow it for people over 18 right now, which kind of sucks. I wish they allow it for kids because I think kids' ID gets stolen a lot, and I hear so many stories about, uncles or aunts or whatever stealing their niece or nephew's ID, and they create accounts, and the kid graduates high school or whatever, and get into college, and they have back credit, and somebody just jacked them up, and so freeze. And so this is, talks about tax and stuff, but gets into freezing your credit, protecting yourself, multi-factor. So I would highly recommend go to 3 credit bureaus if you're not using your credit. Just freeze it for your minors too. Just you got to be careful, help the elderly. So multi-factor authentication, strong passwords, like do good stuff. Use tools like Zoho Vault or One Login or LastPass or whatever, right? I mean, there's always issues. There's no perfect software. There I use Zoho Vault. I like the Zoho ecosystem. I use that. It's a great Zoho One. It's less expensive, so take a look at that. It's alternative to Microsoft and something to look into because you get all these apps and stuff with it. But anyways, and so the next thing about me, Daveed, I'm a financial consultant, ex-IRS auditor. I wrote a course and got a couple books. I got 2 books on Amazon, My Tax Secrets, and then I have a QR code here to scan. I have a a paper that's how to put money back in your pocket instead of wasting it. It talks about tax planning and what you can do, and there's 10 tips and stuff. So go and scan that, or you get the downloads or whatever later. And so just kind of talk about certain things, and then this is kind of concluding my little presentation. And these are like kind of key takeaways, a summary of things that we talked about. And I could talk for days. I mean, my course I've recorded about 15 hours worth of stuff, and it's pretty detailed. And I can talk for a long time, but my voice is getting a little sore. But it's a great course to kind of pick your own adventure. What do you want to learn from? And what do you want to focus upon? And it's meant there's a lot of theory, but there's a lot of practical. So applying that, one eye in the sky and one eye in the ground, and just making sure that we fully understand what, how, when, and where from a tax standpoint, from a legal, and from a financial and accounting, and just merging that trifecta of tax, legal, and accounting together. So I'd love to open up to questions, and my voice is getting a little sore from talking, and I appreciate you letting me share, and I'd love to field some questions.
Yeah, first of all, I want to say thank you, Debbie, so much, because I know this is your crunch time. You're very busy. And for you to put this together and spend some time with us is we really appreciate it. You guys and those online, I think if you want to take down your screen so we can see your face, Debbie, while you're chugging some water. And see, and then anybody online that wants to unmute and ask questions as well. Hello. I know you can't see us, but well, you might be able to see a chair here or there. Okay, anybody have questions? No.
Yeah, thanks for your presentation. The ID pin that you were talking about, do we keep it to ourselves or do we give it to our accountants when they file taxes?
Yeah, good question. You need to give it to your accountant to put it on the tax return itself. Yes.
Madison says no question. Thank you for the presentation. That popped up.
So I just posted the PowerPoint. I use a program called Gamma app, and so it's a great AI tool to help write present. If anybody is looking for a presentation tool, an AI tool, this is a really good, fairly inexpensive tool for writing presentations. You got to edit it. Like with any AI, it's wrong, so you got to keep editing it, right?
Well,
Yeah, I actually have a question.
okay.
Go for it.
Yeah, could you go over and explain what the real estate professional status is and how the IRS checks it, and what exactly needs, what are the boxes that need to be checked for that? I remember like one statement my tax guy told me, which was you have to devote 750 hours a year to it, but what does that mean exactly from an IRS standpoint? And is that even correct? And how are those hours defined?
Yes, that is a fabulous question. I also, so in the chat here, so if people online, and then unfortunately, if you're not online, you won't see the chat, but I put in a real estate professional handout. Let me share my screen again and kind of go through this. And again, I could talk about all of the boring rules, or I could just share this document with you that outlines a pretty good job of what a real estate professional is and the requirements and the passive activity loss. It's just 2 pages. It does a really good job. It's from a resource called the Tax Book. Anyways, and so it does talk about the hours and the limitations, and it cites some code and revenue rulings and stuff like that. So this is
Okay.
a handout. It's a question that I get frequently and often, so it's a really great question, and so this is a good resource for you. Hopefully that helps. I'm not trying to like not answer your question, but I'm just trying to give you the best in the shortest amount of time and let you take a look at it so that you can reference it. You don't have to like make all those notes, you know? Smart.
Follow-up question on that. You mentioned at one point that you sometimes talk people out of being a real estate professional in a particular year. Can you give maybe some examples as to why you would not want to do that?
Yeah, exactly. Why you don't want to be a real estate professional is because I knew I was afraid that you'd ask that. There is some good reasons, and I'm racking my brain right now. And as Grace mentioned, human tax season is frying me. I'm very tired. And I'm not getting a lot of sleep. So some reasons why you would not want to be, I'm gonna stumble here. Let me think about that and get back to you. There are some legitimate reasons of why. Um,
And think about that. What do you mean by real estate professional? What genre of real estate are you thinking, do you know?
A broker?
Which broker? Mortgage broker, real estate,
Mortgage broker.
sales broker?
No, broker doesn't count. Right. Just done, but.
Yeah,
He's shaking.
it's Oregon.
there's some one thing that's come in my mind is if we want to look good to the bank, right? And if we're reducing because we did a cost segregation study, this might be a dumb answer, right? But again, this is what's coming to my mind is that if we want to look at the bank and we're not capping those expenses and we're having enough income because we're in the business of flipping or buying property, right? And we don't, even though we could technically get our income down to zero, we don't want to because of that arbitrage, or not arbitrage, but of that like trap of having to pay hard money versus having to get a better interest rate from the financial institution. So that split, that difference, that delta. And so not being not, for instance, not even having an S corporation, having a C corporation, making life easy. And a lot of people are like, oh, I have an S corp. Well, no. A C corp is going to be better because you get a W-2 and you have higher income and you want to buy that property and you want to make life easy for that underwriter. You don't have to, that deal doesn't want to get killed in underwriting because if you need that cash, you don't have it and you got to get that from the bank. And so sometimes not, especially in the real estate industry, not being a real estate professional because we want to look good to the bank could be one reason. And again, it's that, is it accurate versus relevant? Right? So saying that you should be a real estate professional or not, that could be accurate, but is it relevant to your situation and your goals and what you want to do with the money and your strategy? So often, like I said, it's a lot of times people are like, be a S corp. You got to have an S corp. Not necessary for real estate professionals. You want to have a C corp. Yeah, you're going to pay more in tax, but you're going to save a ton on interest. So just stuff to think about. You want to make underwriting easy. You got to get that money soon, fast, right? Because it's competitive. And you see that deal, other people see the deal too. You want to get that, snatch that baby up before somebody else does. So that could be a reason, one of the reasons why not being a real estate professional, as well as it is so tricky. It becomes hard. I argue with real estate agents all the time, and they're like, "Oh, I'm a real estate agent. I'm a real estate professional." No, you're not. buying and selling property for somebody else, it does not make you a real estate professional. Getting those reps hours in, the 100 hours, with any type of passive activity loss limitation, I mean, some oil and gas, equipment leasing, those types of things, we need 100 hours. It's hard to get 100 hours sometimes, document that, and let's keep that so that you can just be active, not even a real estate professional, but just active, so that you can actually take those losses. And that's not even being a real estate professional, because that's it's a lot more hours. And sometimes it's really, really, really hard to do if you're working another job or you have a bunch of other stuff. The 750 hours or 100 hours more than anybody else, these rules get pretty complicated. And IRS challenges those things a lot. When I was an auditor, I challenged a lot of people, and they would appeal it, and I think they'd just die in appeals. Right? So got to be real careful, I think.
Thanks.
Yeah.
Question on, is there any reason, I mean, as long as TurboTax does, asks all the right questions and everything, do you really, I mean, I just have real estate ones, which just seems fairly simple. And so I haven't had a, professional tax accountant.
Yeah, my argument is garbage in, garbage out, right? And it's not going to be the software, it's the data input, right? It's that GAGO, garbage in, garbage out. And GAGO comes from computer programming, right? So just like with AI, man, I mean, you feed ChatGPT something and it's like, it's wrong. And you say it's, oh, and it says, oh, I'm sorry. And it gives you something else. It keeps on hallucinating. AI hallucinates.
Yeah, it's the
That's
same,
what it does. It hallucinates.
same
And
numbers, same numbers out, kind of thing.
right. And so we want to make sure that we have good numbers. We want to make sure we're not commingling. We want to make sure that we have the right bank accounts and the right protocols. And man, I can talk a long time about commingling and how many people would just come in or they don't have an accountable plan, right? They have an S corp or a C corp or a partnership. Whenever you move from a Schedule C, sole proprietorship, single member LLC, they use the same term like 5 different times. It's like so complicated. It's like, why? But when you start moving into a business without an accountable plan, the whole point about an accountable plan is this, is to take a deduction for the business and not to have to report it as income to the employee. So there's accountable versus non-accountable plan. So with the accountable plan, it's plan documentation that says, as an organization, as a business, I'm going to reimburse my employees. And as a single, it could be one person, right? Single member S corporation, LLC, tax and S corp. Let me back up. I'm going to go off on a tangent. I know I'm in the middle of 5 things that I'm saying right now, but this is really, really important. LLC is a state by state designation, and then you go tell the IRS how you want to be taxed. And there's 4 primary ways that you can be taxed. As a sole proprietor, single member LLC, disregarded entity, same thing. A partnership, more than one person, a C corporation, or an S corporation. Those are the 4, and there's trusts and estates and LPs and LLPs and all these other designations. But it really boils down to how do you want to be taxed. And so then you get to choose how you want to be taxed. So if you're a sole proprietorship, then that's a Schedule C. It's easy, right? You should keep accounting records and double entry and all that stuff most time. And because there's basis and there's stuff like that, but it's less stringent. But when you have to report a balance sheet, because of Schedule C, you don't have to report a balance sheet. But with an S corp or a C corp or with a partnership, you got to report a balance sheet. Yeah, it's under 250, you don't have to, or there's some exceptions. But a lot of times people get over the 250 threshold and you have to report. And that's where the adjustments are. The number one thing that a good auditor is going to audit the balance sheet. And they'll go into the income statement to look and see. But the majority of adjustments are on the balance sheet. The balance sheets are where it's at. Most audits are made, most adjustments are made on the balance sheet. Balance sheets are key. And that's where that also sinks people in other due diligence claims. In divorces, disagreements, in lawsuits, the balance sheet, when people commingle and they don't have the right documentation, they're not have the loans. Oh man, so many times people don't have the right loan documentation. And it's just, I see this entry due to and due from on their balance sheet, and there's no loan, there's no repayment schedule, there's nothing to verify. It's just make believe, right? People are like, I have this LLC. Yeah, it's like tissue paper, right? It doesn't hold up, right? It's the three little pigs, the little pig, the little straw and the sticks, and then they got the house that's built out of bricks, man. That's what we gotta do because those litigating attorneys, those IRS auditors are gonna just huff and puff. They're gonna try to blow that house down. And people are like, oh, I got to sell this. Yeah, it's tissue paper. It's nothing, man. It goes right through it. So what? We got to have documentation. The accountable plans are so key. And we got to abide by those because it's dotting the I's, crossing the T's. They'll go in there and I've seen it so many times. I was that guy that would just say, well, sorry, you have the expense, but we got to pick it up as income on your personal return. You underreported your W-2. And then we got a W-2 issue, a huge issue. And then it just jacks everything up. It's just a nightmare. It goes downhill. But, sorry, you didn't abide by your own rules. Set up these rules and you didn't set them up. Nobody ever told you. So I would ask, please be careful. Do your due diligence.
Yeah, I'm just the sole proprietor, so it's
Okay.
pretty simple, I guess, as far as prior to
Okay.
that, weren't no partnerships and all that good stuff. No corporations.
Not yet.
I guess.
Hopefully soon.
Yeah.
Okay. Yeah. So I put in some resources in the chat and I hope Grace can share those with
Yeah.
people who are in the room and send those out to people or whatever. I can email those to Grace and stuff, whatever I can do to help.
I'll be able to get them out of the chat and send them out tomorrow.
Okay.
As long as I have y'all's emails, on my system, which I'm guessing since you're here, I do. So thank you. Daveed, it was awesome. Thank you. And
Thank you.
a lot of scolding maybe, but it was awesome.
I'm sorry. I didn't mean to. Hopefully I was kind and gentle. I just better now than in being in front of an IRS audit and you have like 30 days and the clock's ticking or a vicious litigating attorney, right? I mean, again, I don't want to take you to the woodshed, but sometimes we might have to have a stiff talking once in a while. Just like books and record, nobody wants to do this stuff, man. Nobody wants to do this. But it's so important that we do, and especially as AI is coming to either help us or hurt us, we want to be on the right side of history.
There you
We
go.
want to use technology for our benefit and not to get our butts kicked.
Well, it's always good to have a geek on our side. Thank you very much.
Alrighty. It was nice meeting everybody, and I'd love to come down hopefully in the spring after tax season, and especially around the pre-Fontaine Classic and stuff. Like go see Hayward Field, and I love that place. So hang out.
Thank you.
All right. Cheers. Bye-bye.
Thanks.
4 people left. All right, guys, thank you. Glad you made it, Jean.
Probably not have 100 hours a year, I think somebody every 2 years have a roof.
Well, I'll send you that document that he posted. I don't know what that was, but it said 30.
Start out, a C corp at the top of your tax, you don't learn them into a C corp.
You don't want to start there. That's the way I learned it, yeah.
It's just,
I
mean, it's not like I've done this for like 2 or 3 days.
An S corp is a designation. I have the S corp now, but yeah, it's a designation. So I have an LLC, and I have a couple of LLCs, and they're designated under the Gratefulness Homes as a C corp. So this is an LLC. This group here is an LLC, and then I didn't understand that my accountant CPA made a designation for Grateful Nuts as a C corp, and this one folded into it. So I was filing 2 Or I couldn't figure out why she wasn't filing too, let me put it that way. But, and she's like, and then I was paying ADP 2 times to send out and all this when I only needed the one, so. And so he explained all that to me.
You can't become a real estate professional until you